Hey guys, this is Anant here. I'm back with part 2 of our investment series. Today I'm going to be covering equity. Equity is a word which we use on almost a daily basis about how we can invest in the stock markets. Now, these might seem a little bit more technical words, but I'm going to break it down for y'all so y'all understand it in the most basic sense. The stock markets are markets where you can buy and sell shares of a company. So what is an equity share? An equity share is a part of a company. Now, this might seem a little bit more confusing, but just stay with me for another minute. Think about a pizza. When you divide the pizza into 4 equal parts, that means you and your friends, if any, have 25% each of that pizza. You can keep dividing it equally and everyone will be entitled to that one slice of pizza. Similarly, a company divides itself by issuing shares. That means if a company is worth $100,000 and it has about 1,000 shares, that means every share is worth $100. So the more shares you buy, the more ownership you can have in the company. The more shares you have, the more profits and the more part of the company you own. Now, in the share market or the stock market, we can go and buy and sell shares. That means that if you own a part of the company and you want to sell that off in exchange for money, you can go and trade it in the market. Think about a share market like a supermarket where the sellers are selling and the consumers are buying. We have 2 prominent stock exchanges called BSE and NSE, which is the Bombay Stock Exchange and which is the National Stock Exchange. Both of these places have attracted enough buyers and sellers so that shares can be exchanged over different platforms. If you would like to buy and sell shares, you can go to brokers like Zerodha, like HDFC Security, like Kotak Securities, or any of your local sub-brokers which enables you to open a dmart account and buy and sell shares. Now, once you buy and sell a share, on what basis are you supposed to buy and sell a share? The very basic thing which you should do is research about the company. Now, what kind of research would you want to do about the company? Primarily, 2 schools of thoughts. One is fundamental analysis and one is technical analysis. Fundamental analysis talks about the very basic, important information about the company. I'm going to cover technical analysis in a different video, and I'm going to focus on fundamentals a little bit right now. Fundamental analysis helps us understand what has happened in the company till date. What that means is that what has led to the company to this very point. We will analyze financial statements of a company. A company, by law, is supposed to issue its financial statements to its shareholders. This information is open to public at large. What is the total sales of a company over the last 12 months? What is the total profitability? What is the cost of goods which they have purchased, etc. This will help you understand different metrics of how a company works. You wouldn't want to buy a company which is neck deep in debt. By debt, I mean they've taken a lot of loans because all the profits will first go in paying off the debt holders. You would want to buy a company which has 0 or less debt or has the capability of paying off heavy debt if possible. Reliance Jio, before all its acquisition, before all the news it made last year by attracting billions of dollars, had raised $20 billion in debt. No one really knows this, but they had, and one of the primary reasons for them to sell a part of their company last year was and get the right kind of investors, global investors, was to ensure that they could pay off their debt, because for having debt you have to pay them interest every year. Colgate, again, is a company which is listed on the Indian stock exchanges. It's called Colgate-Palmolive, and it has 0 debt. Now, Colgate is one of the most beautiful companies which is there, right? Because Colgate is something you use almost once to twice a day. It's used in every single household in the country and has 0 debt. It's become a lifestyle brand, if I can so call it, because the toothpaste is actually, if you go to a shopkeeper, you ask for Colgate now. And that has enabled Colgate to become a household name, has reduced the cost of marketing, and enables him to ensure that its sales are robust. So this is one of the ways which you look at in a company holistically. But fundamentally, what should you look in Colgate's balance sheets? Has the sales year on year increased? If, for example, Colgate sales last year was 1 rupee, has it increased by more than 1 rupee? If yes, and by how much? Now, compare this growth with the growth which happened the year before that. For example, in 2019-20, if the growth had been 10% and in 2021 it had been 15%, that means your company is doing decently well. And this again enables a company to grow because the main thing which you need to understand is how much can a company sell and how much money can it bring in. So this gives you a very, very simple characteristic of a company is the more the company is able to sell and get the money in the company, not have too many receivables or debtors, that would allow a company to be able to grow robustly over the years. That's number one, look at sales. Number two is always look at the price you pay to buy the share. By that, what I mean is there's a IPO which debuted about a few years ago called Avenue Supermarts. Avenue Supermarts is nothing but dmart, which we go and buy, again a supermarket which we use almost on a daily basis. Avenue Supermarts debuted, you could buy at $2.99 at the IPO stage. And when it debuted on the stock market, it had become 600 a day. So you doubled your money in a day. Today, Avenue Supermarts trades above 1,000 rupees. But the price, according to fundamental analysis, is that for every 1 rupee of profit, which Avenue Supermart makes, you have to pay 100 times to get the share. That also means if the company makes 1 rupee for the next 100 years, is the only time when you will be able to recoup your money back. Obviously, I've not factored in growth over here. So you can also put growth percentages and obviously the number of years to get to break even on your investment will be lowered. Another way of looking at it is by saying that it will take us 100 years to break even. It will take 100 years of 1 rupee of profit every year for the company to get your primary price which you've paid. So please understand Warren Buffett's very famous statement, price is what you pay, value is what you get. And this is exactly why you should find stocks which have high growth opportunities, which have a lower price to equity ratio. Price to equity ratio. Price is what you paid and equity is what you're getting. So I hope this helps you guys make a sound decision. Fundamental analysis talks about everything which has happened. It does not talk about where the company might lead towards. You're looking at how the company has done, the history, the past, to understand how the future can be predicted, on what foundation the company has been built. So I hope you enjoyed this. And in the next video, I'm going to be covering more of fundamental analysis, key points, which you must look at for you to make a sound decision on investing. Thank you so much, guys.